from Central Bank of India, having vast experience and knowledge, and is as a faculty is working with us. He is visiting faculty for our institute for the past several years. He's taking different subject in CIB. Is mainly taking these two, then retail banking, credit management also sometimes. So he'll be handling this both the modules. Sir, I welcome you, sir, on behalf of all the participants and IBS to this forum. And now it is over to you. Warm welcome to you, sir. Thank you.
Thank you, sir. Thank you very much. Thank you very much, and I welcome to all the participants also. So, as sir told you, only few days are left for the examination. So I think you are almost ready with all your studies, etc. So we'll go as planned. So I'll be taking this module B and module D. So first module B will be completed. After that, module D will be completed. So, and after completion of each module only, the PPT will be shared. That is my thing. So PPT will be shared after module B is completed. B PPT will be shared. After D is completed, D PPT will be shared if at all you wanted to refer to such PPTs. Okay. So that is my plan actually. That is the thing. So without much delay, we'll start because the time is very short to complete the entire thing. Risk management as well as balance sheet management. As sir told you, there are a lot of things common. Around say 30% of the contents are common to both the things, where mostly the risk management part are coming in balance sheet management also. So those things will be covered. Whatever is I will cover in risk management, that I will not cover in the balance sheet management. Little things are there which can be covered, that I will cover in balance sheet management. Only part of risk management is there. Okay. So we will start without any point of time. You have any question, you may either you keep that question with yourself, and later part of the after completion of the session at around 7 o'clock, you can ask, or you can ask by unmuting yourself, and or you can ask through chat box also. There is no problem. But be sure that we always ensure that the noise should not come, background noise should not be coming. Okay, please keep your mics in a mute position always. Only if required, you can unmute your mic. Okay. So with this, I will start the risk management challenge. First, we should understand what is risk. First, we should understand the meaning of risk. Then, if we know the meaning of risk, then it is easier to why we have to manage the risk in our banking business. Banking is a totally financial business. So each step we take in banking, each transaction we do banking, there is a risk there. If we do not manage that risk, then it will be a difficult part for us, because there might be some loss to the bank. So to cover that thing, we have to manage the risk. So risk, the literally meaning of risk is, you can see that if you look into the dictionary, so literally meaning of risk is run into danger. Means there is something is danger is there, we are going to experience that one. You are going inside the danger. Means you are, rather I can say you are encountering the danger. So that is the basic. Means normally when danger is there, but still you are entering that zone of danger. So when you enter that zone of danger, there might be possibility of some injury or some harm, or in financial business we can call that there will be loss. So that's how you can call it a risk. Means we are encountering with dangerous thing where we can experience some kind of loss. Okay, so that is what basically the meaning of risk is when you refer to literal meaning. Okay. Now, we know that every action we take, whatever action we take, whether it is personal, professional, or your any type of action you are taking, there has to be a reaction, because we are taking this reaction to get a reaction from it. Any action we take, verbal, non-verbal, or whatever we do, we always take the action to get a certain amount of reaction out of it. That is our objective. Okay. So this reaction, so whatever we do, we want some result out of it. Reaction is the result, some result. For that reason, we are doing something. Whatever we are doing, we always want a result. And this result can be of two types. This reaction or result may be positive or may be negative, because you do not know. You are doing it. It may bring in positive result or it may bring in negative result also. Because now you are preparing for the examination, Caiib examination. On the day of exam, you will know your result. So most people will have this positive result. Some of the people may have negative result also. So when the result is positive, so we can say that when the result benefits us, our result is favorable. So when the result is benefiting us, our result is favorable, then we are happy, or there is no point of worry at all. So we do not worry at all. But when the result is against us, against the interest of us, or it is unfavorable. So whenever this result is against us, against the interest for which we have done something or we have attempted something, and that becomes unfavorable, then only we worry. And here, when we worry, we always think of risk that time. When we do not worry in the positive case, we do not think about risk at all. We do not think about risk at all. But whenever this negative result comes, we always think about risk. So risk comes into picture when there is a negative result. So we can say that risk is therefore a possible outcome of a negative result of our action. So when there is a possibility or already a negative result is there, then we can say there is a risk. And we could not manage the risk properly, for which there was a negative result. So this thing, when you do something, there are two possibility results. So when there are two possibility results are there before you get that result, that means we are not certain about the result. So risk can be said as uncertainty. Risk is an uncertainty. And this uncertainty have two types of result, out of which when the result is negative, then we can call that it is a risky thing we have encountered. So we can further say that risk is an uncertainty. Risk is an uncertainty about the consequence. Consequence is the result, whatever. That may result in negative outcome or negative impact. So we can say negative impact. The impact will be negative. So whenever this impact will be negative, then only we see that there was a risk, and the risk could have been managed efficiently to prevent that negative result or prevent that loss. So in such cases, so we could understand the meaning of risk. Okay, so we can say that for bank, we can say that for bank or any other financial institution, risk is the negative deviation. So negative result is, we can say, negative deviation in what we achieve from what we had planned or what we had expected. That means what? Banks try to make profit, or they set different targets. Different targets are set by the bank management every year for deposit, for advance. So a lot of things are there where bank actually set different types of target. Okay. In such cases, what happens? So when targets are set by the bank, say we set a target of profit only profit target I'm talking about. So bank says that next year my profit will be say 200 crore. And this year profit was say 160 crore. So we have set a target of 200 crore for the next year. Now what has happened? Next year, after the year is completed, we saw that the profit was 180 crore. That means our target or our plan or our expectation was 200, but we have achieved only 180. So there was a negative deviation. There was a negative, although profit was happened, these are the profits happened, but still there was a negative deviation. So we can call that we have experienced or we have encountered risk which could have been managed properly to achieve our target, but we could not achieve that target. Similarly, suppose there was no profit, only there was a loss of say 50 crore against our target of 200 crore. That is also a negative deviation. So negative deviation means it might be a profit or it might be an outright loss. Whichever it is a negative deviation from what we have targeted or what we have planned or what we have expected. So risk is the negative deviation in what we achieve. What is our result from what we had planned or what we have expected. That is what was our target. Okay. Now we can see that the risk comes into picture, and this is uncertainty which might be positive or negative, or this is the action we do and there might be positive or negative. So when negative happens, that is the result. Now this action can be our own action or anybody else's action also. So what we are doing, majority of the thing, maximum time, it is due to our action that the result is coming, whether the result might be positive or negative. So for our action, there might be a negative result, or for anybody else's action, it is not our own action, the result might be negative also. Because whatever we are doing, our business is banking. So banking business may be also encountering some sort of risk or some sort of loss where our own hands are not there, but it is due to anybody else, means outsider hands. So that means if it is our own hand, due to our own thing, we have encountered risk and we have reached a negative result, then we can say that this is within our control because it was done by us. We have done it. So it is within our control. Within our control. So those things which is within our control, those things could have been managed, which are due to our own action, that could have been managed properly. So risk management can be applied on this to prevent this loss. But if it is due to anybody else's action, that might not be possible to manage. So those things are beyond our control. Some things can be controlled, but most of the things will be beyond our control. Because, see, normally, suppose you are, you have purchased a car. Suppose you have purchased a car. So you have purchased a car, a new car, you are driving. So you will be always careful while driving the car. When you drive in the city, you should be always careful. It's a new car, you should not damage the car or damage yourself, or accident should not happen. So you will be always obeying the traffic rules. You will be always going through the signals, red light and other things, green light. And you will never overspeed, never try to overtake, never do rash driving. Everything will be there. So you will obey all the rules. Means you are managing all type of risks. So you manage all type of risks to avoid the accidents or damage to your car. So this is the negative impact. So you are taking care of risk management. You are driving very carefully. You are obeying all the rules to avoid the accident or the negative impact. But it might happen that you are driving the car. Suppose you are standing at a red signal. The red signal is there. You are standing. Suddenly what happened? From behind your car, one truck or one auto, something comes and accidentally hits you. So it is not your fault. It is anybody else's fault. Due to his action, your car got damaged. So this accident happened and there was a negative result due to anybody else. Though you have taken care of all things, you might have also put some of the steel bumpers everywhere, the backside and front side of a car. Still, the fault was somebody else. He has hit you. So you have also damaged your car. So there was a loss to you. So that loss can be, or negative impact can be due to our own or due to external. So our own are called internal impacts, and anybody else, I mean, these are external impacts. Suppose you have a house, so many people have a house, suppose earthquake happens or tsunami happens. What you can do? Those are totally natural disasters. This is an act of God. So you have no control. Your house might be damaged. Your city might be damaged. So in that case, we do not have our control. So internal controls can be done, but external controls are almost impossible. So internal actions or internal impacts can be managed. So risk management is applicable more to the internal impacts or internal actions, whereas external actions have very least amount of protection to our damages. So risk is always, we can say that risk has to be taken, because we take risk every time. When you are crossing the road also, where traffic is there, when crossing the road, you are also managing risk. You are taking risk. To avoid risk, you are looking at left, right, and then after that, when you see that no vehicles are coming, you cross the road. Because you cannot cross the road with full risk, 100% risk. It means you blindfold you close your eyes and cross. So some vehicle might hit you. So we take a risk every time in our life and do a lot of things. Why we take risk? Because we know that by taking the risk, we have to achieve some result. We have to achieve some result. So we are doing something. So our action is to get the result. For that, we have to take risk. We take that risk. So without taking risk, we cannot reach that result, or we cannot cross the road. Other side, you cannot go. So how you are managing the risk, how you are taking the risk, it is totally dependent on yourself. How you are going to, because the type of crossing the road by me will be different from type of crossing the road by somebody else. So we can say that this risk-taking capability is taker specific. How the person who is encountering the risk, how he is managing the risk. So that's why you will see that in your bank, so many branches are there and so many branch managers are there who are heading the branch. All the branch managers are not same type of branch managers. Means some of the branch managers might be taking risk by giving loans, number of loans, amount of loans they have given. But some of the branch managers are totally averse to the risk and they do not want that any would be given by them. Such type of people will see. So risk taking is totally taker specific. It depends on the person who is taking the risk. So question might be arise, why some people are willing to take risk and others are avoiding to take risk? Because they know, the people who take risk, they know that risk is directly proportional to reward. Risk is directly proportional to reward. In the sense, if you take risk, there is a possibility of higher reward. Mark my word, there is a possibility of higher reward. So the directly proportional, why I told you, why I didn't tell you that risk is equal to reward. No, because this reward again can be positive reward, negative reward, as I told you, because risk is an uncertainty where the impact might be negative or positive. So reward means it might be a, say we are talking about high profit, or it might be also high losses also. Both are possible. So when high risk is taken, then high profit might be there or high loss might be there. So similarly, when low risk is taken, so according to that, there might be a low profit or there might be a low loss also. So anytime you take risk, there is a possibility of both plus and minus. So possibility of low profit, low losses for low risk taking, high profit, high losses are there for high risk taking. So more risk is taken in view of the fact that there is a underlying higher profit. Higher profit possibility is always there. So if you manage the risk properly, then your result might show that higher profit. So for that reason, some of the people, they are always willing to take risk because they know that I am working for the bank and I will bring more profit to the bank. So how this is possible that some people are taking, some people are not taking? Because these people who take risks, are they aware of some fact or some technique? Yes. So we can say that there are practical ways or there are ways to manage the risk and get the desired return. And this is through management of risk. So that's why it is called risk management. So those people who know this risk management, they take risk and they bring in higher profit to the bank. They know that there is a chance of higher losses also, but they ensure that they will be doing the risk management properly to get the desired return. See why these are I'm discussing, because in bank all the things will be applicable, because at this time I will tell that entire risk management subject is about preventing losses. Preventing losses and bringing more profit. Preventing losses means we should always see that losses will be less or it will be nil, so that our profit will be more. So entire risk management, whatever the process is, you have to take care of risk, manage the risk to prevent the loss. In anything, whatever you are doing in bank, our job is to prevent the loss. So why we should prevent the losses? Because if losses will be continuously incurred by the bank for years together, so first year loss will be there, second year loss, third year loss, like this continuous losses will be there each year. That means one day our bank will be collapsed, because the losses will be continuously and they will be eating away our capital, because loss has to be appropriated from the capital only. So when the capital is gone, when the capital becomes zero or capital becomes negative, this is a position where we can call that bank has collapsed, or that is the position of bankruptcy. So primary objective of risk management is that to avoid bankruptcy. Simple thing. We have to prevent loss to avoid bankruptcy, because we are dealing with the money of public. Public money we are giving as a loan. We are utilizing that money. So if bankruptcy means public money is gone. So entire trust of the public will go on the banking system. So we should always see that we should not face a situation of bankruptcy. So we have to prevent loss. So how to save the bank from bankruptcy or prevent bankruptcy? So simple way is of risk management is capital. You should strengthen your capital. Strengthen your capital. Build your capital. Every year you put in more capital, more capital. And this capital comes from where? This will be coming from your profits. So earn more profit, build your capital, grow your capital. So as you grow in business, you have to grow capital so that in case of bankruptcy situation, the capital will be absorbing your loss so that you can prevent bankruptcy. So that is the basic thing of risk management. You should know. Entire risk management, we will talking about capital. How to manage capital, how to strengthen capital. That is the only thing of risk management. So prevent loss or build more capital to prevent bankruptcy. We should, that is the only motive of risk management, nothing else. Now we'll see that. Already I have discussed these things. So uncertainties are internal and external. So both can be there. Internal can be managed by us, but external factors are there which are beyond our control. So we cannot manage those things. So external forces influencing the process of our banking cannot be managed fully. So risk management will not be applicable to those external factors fully. Some of the external factors can be managed, but those which are internal factors, that can be easily managed. Okay. Suppose I'll give a simple example so that it will be clear for you. Suppose you are you are selected for a job, and before you are fully selected, you have to attend an interview. So the final interview is there on such and such day, fix such and such day, it is there, and fortunately it is in your city, suppose. So interview will be held at say 10 a.m. At 10 o'clock in the morning, interview is to be held. That means it is very important for you to reach the venue of interview before time. Or suppose you are going to attend your Caiib examination day. So that exam starts at 10 o'clock. That means at least by 9:30 or 9:45 you will be there. Otherwise, if you are going after that, the examiner or the people who are invigilating, they will not allow you to enter the hall at all. You cannot sit for the examination. So to reach the venue before time, you need to, first thing is that you have to get ready on that day. Get ready by all means. By 9 o'clock or something, you should be getting ready. Then from your house, after getting ready, you have to go to that venue. So either you have your own vehicle is there, or you have to go by a cab or arrange for any type of transport, cab or say auto or whatever it may be. And third thing is that you have to travel that distance. Travel the distance to reach your destination or reach the venue. So these three things are required to reach the venue at your 9:30 or whatever your time desired, because 10 o'clock is the time of examination or interview. So these three are the main things which are to be done. You should be get ready. You should be ready before 9 o'clock. You should arrange for a vehicle, your own vehicle or cab. Then you have to travel that distance. These are the three factors which are inseparable. Without these three, you cannot reach in time, because the process of reaching the venue is related to these three factors. So this we can call, these are the factors of achieving the result, getting, say, we can say reaching the venue before time. That is our aim. Now there are certain other uncertainties which may affect any of these factors or all these factors, which might make you to reach the venue after 10 o'clock also. I mean, due to uncertainties, you may fail to reach the venue at your desired time. That means, what are the uncertainties might be? Either you get up early and get ready in time, or you, suppose you missed your alarm and you are not getting up in time, then you would be delay in getting ready. So there might be a delay in getting ready. Second thing is that if you have your own vehicle, then fine. Otherwise, you have to book a cab or book a auto or go by bus or whatever it may be. And while doing so, the cab or auto or train or bus, whatever, that did not arrive in time, or your vehicle did not start because you forgot to fill petrol in your vehicles. There might be some uncertainties regards the vehicle, which might also delay your thing. Third thing, when suppose you are traveling, you got the vehicle, you are traveling on the road also, the vehicle might encounter some of the problems. So your vehicle might be stop on the way, or there might be traffic jam also. If a traffic jam is there also, then there is a possibility that you will not reach the venue at time. So these are the different types of uncertainties which affects the inseparable factors which might delay the time, and we may fail to reach the venue as per our desired time. Because if everything goes well, you will reach well in advance as planned. If something happens in between the process, which might be due to the uncertainties, you may not reach in time and you will be disallowed to appear for the interview or appear for the examination. So these uncertainties are the instruments, or they become the instrumental things in one's failing to reach the destination in time. In other words, there is a risk of reaching late for the interview, which is due to the uncertainties associated with the factors we have discussed here. So we can say that risks are the uncertainties in adverse outcome. Adverse outcome means reaching late, not getting profit, and adverse outcome in relation to our objective or our goal or expectation or our target. Our target was to reach 9:30 so that we can attend the interview 10 o'clock. But this type of uncertainties, they did not allow us to reach in time. So to reach in time, we should have managed the risk. Means managing the risk means you should put an alarm so that you can get up by 7 o'clock or 6:30, get ready, do everything. You have checked your vehicle in all respect, that petrol is there, it is starting. So yesterday night you have checked everything running fine, there is no problem. Traffic jam is a possibility that is not possible. So to avoid this, instead of starting at say 9 o'clock in the from your house, you could have started at 8:30 or 8:15. Start early so that you can, even traffic jam is there also, you can reach in time. So this is called the risk management. So bank also, in financial business also, we do the same because we have to manage those things. So basically, you can say that financial risk is the uncertainties in adverse variation of profitability or outright losses. This I have explained to you that 200 crore was the target of our profit, whereas we have achieved 180 crore profit. So this is the negative deviation. So adverse variation of our profitability, where the targets were 20, or it might be a straight away loss of 50 crore. Two possibilities might be there. Your target of profit 200 crore was not achieved. It was profit, but it was plus 180 crore only. So this is also an adverse variation, and outright losses is this. Straight away you have encountered loss. Okay, so financial risk means bank risk is two things: uncertainties in the adverse variation of profitability. This is the adverse variation of profitability, and this is the outright losses. So both are to be seen as financial risk. Okay, so financial risk is the probability that the realized return would be different from the anticipated or expected return on the investment we made. So we are doing the business by making some investment. So our target was 200, our anticipation to get 200 crore. But instead of that, we have achieved either this or this. So this is the probability. Probability is that either there will be a profit which is lower than this, or there might be a straight away loss. So that two things are encountered. Outright loss means I have explained this. This is the outright loss. Straight away loss figure is outright loss. Outright loss means straight away 50, any loss, even 1 rupee loss is outright loss. But till the profit is made, we cannot say that it's a loss. So profit is coming down. Still a profit figure of 1 rupee profit is still a profit. So we cannot call it as a outright loss. Outright loss will come when there is a -1. So that is outright loss. Okay, outright means straight away loss. The result shows that it is a negative figure. That's why it is called outright loss. Okay. Now, this profit and loss in our bank, we do some transaction. Whatever transaction, bank's business is accepting deposit for the purpose of lending and investment. Simple thing. These are the things we do. These are the core business. Other than that also we do. Whatever we do, the business, this is to earn profit. So that we should continue doing business and continue making profit, and to continue strengthening the capital to avoid the bankruptcy. That is the main thing of banking or risk management. Now, whatever we do, this deposit, loan or investment, whatever is done, our result has to be profit. So that time, sometime it might be loss also. So basically, the profit or loss of the bank profit or loss of the bank entirely depends on the two things: cash inflow and cash outflow. If any type of business you do, there would be cash inflow or cash outflow. And the equation is, when you cash inflow and cash outflow together, you adjust this together, we get that net cash flow. So net cash flow is cash inflow plus or minus cash outflow. Basically, outflow is when you talk about outflow, this will be a negative thing and this is the positive thing. Because profit, when we see, when the cash is coming into the bank, when it is coming means it is a inflow. So inflow is a positive. When it is going means it is outflow. So net cash flow will be the sum of cash inflow and outflow. So we can see that, so profit or loss in a business depends on the net of cash inflow and cash outflow. So the equation is net cash flow equal to cash inflow minus cash outflow. So whenever this cash inflow is greater than cash outflow, then we have a profit. Cash inflow is greater than outflow, then it is profit. Whenever it's the reverse, there is a loss. Simple equation. So that means what? It means uncertainties which are associated in both cash inflow and cash outflow would eventually change the net cash flow. So according to that uncertainties in inflow and cash outflow, either we will have a profit or we have a loss. So what I am suggesting or I am indicating to tell you is that these inflow and outflows are the main thing, and the uncertainties in this inflow and outflow will result in either profit or loss. So you have to be very careful in managing these uncertainties which may be there in cash inflow and cash flow, so that we can prevent this loss. This is our motive in risk management. Okay, because simple thing, I will just tell you another example. Suppose somebody is doing some business. Say he is selling vegetables. So he buys from somebody and he sells it. Okay. Now this is his selling price. This is his sale. And this is his purchase. Sale, purchase. So purchasing, suppose he has bought, say yesterday he has bought, say it is about a tomato, he has purchased, say 80 kilo of tomato he has purchased, and per unit he has purchased, per kg, the rate of tomato was 12 rupees. And from that place where he has gone to, that place where he has purchased, that wholesale market or the farmer place, whatever, he has carried to his market where he is going to sell. So there was a cost of transport 200 rupees and other cost, related cost is 200. So total expenses he has incurred yesterday to carry that 80 kg of tomato, he has spent 1360 rupees, which was his outflow. So his outflow yesterday was 1360. Today he has purchased 100 kg and the price was 8 rupees kg. Transport cost was 250, administrative expense 200. So he has spent today 1250. Tomorrow it might be possible that he will buy 50 kg only as per the demand, and rate might go up to 15 rupees. Transport cost might be 100, 200 administrative cost. So he might spend 1050 rupees only. Accordingly, while selling also, you see he has sold at 12 rupees kg only as per the price available now in that. So inflow was only 960 rupees. So outflow was 1360, inflow was 960 yesterday. So what is the result? The result would be definitely it is a loss because he has spent more than his thing. So 400 rupees loss was there yesterday. Now today what has happened? He has spent 1250, 100 kg he has sold at 15 rupees. So 1500 was inflow. That means inflow is greater than outflow. So he has a profit of 250 rupees today. Tomorrow it might be a loss of how much? 550. Because he has sold at 10 rupees per kg. So 500 rupees was only his inflow. So that means what? This uncertainties has arisen due to that there was a price change. So 12 rupees became 8 rupees next day, then it became 15 rupees next day. Then there is a volume change also. 80 rupees is sold to 100 kg and that might be volume change also. There might be change in the transport cost or that might be change in the administrative cost. So there are different kinds of uncertainties are there into these are the factors. And this thing changes the outflow. Similarly, here also, he might not be able to sell the full volume also. He has sold it, but as well as price might change according to demand and supply. So due to this change also, his inflow might change. So change of outflow, inflow will impact on the result, that is the net cash flow. So net cash flow will show you whether you are earning profit or loss. So banking business is such. So this, what I told you, somebody has asked some question, I think 1 minute. Sir, please show the previous slide, okay? What you want in the previous slide? I have already told everything, there is nothing today. Same thing I am repeating here. Is it done?
Yes, sir.
So what I was telling that uncertainties in both cash inflow and cash outflow would eventually result in the net cash inflow either in profit or loss. So this affects our result. So if the result is favorable, we can say that yes, it is a profit. If it is adverse, we say it's a loss. So this possible adverse impact, whatever the possible adverse impact means, whatever the loss we have suffered, this possible adverse impact in our business is called the risk in business. Remember this, sometimes question come, what is risk in business? The risk is business is not, risk is business is that possible adverse impact in our business which might lead us to losses. So what is that adverse impact? Those adverse impact are those uncertainties which have affected our cash inflow or cash outflow, for which there was the negative net cash flow. So these adverse impacts which may lead to losses, they are called the risk in business. And the factors I told, the factors which changes the uncertainties, the factors that are responsible for creating those uncertainties, change in the volume, change in the price, change in transportation cost. So all these things are uncertainties. So the factors that are responsible for creating those uncertainties in the cash inflow or outflow are called the risk elements. These two things you should always remember. What is risk element and what is risk in business? The factors are called risk elements, which influences the uncertainties. So our cash inflow and outflow changes. They are called risk elements. and that possible adverse impact that happens, that is called risk in business. That means the loss which happens. Okay, certain time MCQs are asked on this, so you should be careful for that. Understand that what is risk. What is risk in business? So basically, the possible adverse impact is called risk in business. The factors that are responsible creating the uncertainty in cash inflow and cash outflow are called risk elements. Okay. Now, what is high risk business and what is low risk business? So basically, as I told you, when you are taking high risk, anybody taking high risk, this may result in two possibilities. Two outcomes will be there. So there might be high profit, or you can call high gain, or there might be high loss also. So similarly, when we talk about low risk, possibilities are two again: low gain or profit, or there might be low loss. So we can say that how this is possible. So these are the two possibilities happening all the time. So this, what is this high risk business and low risk business? So we can say that this is due to the variability in the net cash flow. So when the net cash flow variation is high and it is favorable, we call it high profit. When that net cash flow is unfavorable, we call that high loss. Same thing happens for low risk also. When the net cash flow is there, but it is comparatively lower, we can call that low profit, or when it is low loss, then it can be low loss. Or in risk management language, these are called higher upside potential. When profit is there, that is called high upside potential. And when loss is there, they are called high downside potential. So high upside potential and downside potential, you should remember that. So those businesses which results in high upside potentials, we can call that those are high risk business. So there is a possibility of high upside potential as well as high downside potential, both together. Those are high risk, where such business which might result in low upside potential and low downside potential, they are low risk business. Okay, so low risk implies lower variability in the net cash flow. Net cash flow. High risk means higher variability in the net cash flow. According to that, higher profit might happen, higher loss might happen. Here, lower profit might happen, lower upside, lower loss might happen. So these are basically the thing we should understand, that how this lower risk implies lower variability in the net cash flow. And sometimes we, in banks or in financial business, we also come with a term which we call zero risk or risk free. What is this zero risk or risk free? What would you understand by this zero risk or risk free? Is there anything really possible that it will have a zero risk or it is totally risk free? No, this is not possible.
Sir, can you explain the low risk once again, please, sir?
Suppose this is me and this is you. Okay, this is me and this is you. We are trying to cross the road. We are trying to cross the road here. Okay.
Okay.
Okay. And while crossing the road, I have taken care of all the risk and I saw left, right, everything, and I crossed the road running. So I have taken high risk and I have reached before you. You are taking care of all the risk, but slowly you are passing by the road, taking more risk because you are afraid of things. So I have taken high risk and I have reached earlier than you. Say I reached here, say 50 seconds or 1 minute earlier than you. You took you took more time to cross the road. So that
Okay.
means what? That means my reaching was more. So I had a higher profit here, or gain was high because I have taken high risk.
Okay,
So
sir.
there was a possibility while running, there might be a possibility that some vehicle might have hit me. In that case, my legs or my hand might have broken. So there was a possibility of high loss also. So both are possible. Since you are taking very low risk, very less risk, very careful. So
Okay.
though you have reached late,
Okay.
you could have encountered that accident, but injury might have been less, or you might have just slipped down and that vehicle might have stopped also.
Okay. Okay,
So
sir.
you could have, so your result was less profit, but very less risk also. Do
Okay,
you
sir.
understand now? So
Yes, sir.
high risk means both are possible. Low risk means both are possible.
Okay,
As
sir.
comparable to high risk, this is what the main thing. Okay. So in bank also same thing. Possibility, chances of both the things are there. Now it is according to how you have managed the risk, how you have managed the uncertainties. If you have managed efficiently, high profit will be guaranteed. If you cannot, high loss will be also guaranteed.
Okay. Okay. Thank you, sir.
So sometimes we see that risk-free or zero risk type of things are coming. It is not possible. So what is those risk-free investment or risk-free thing we do? It means that there would be no variation in the net cash flow. So we have understood when the net cash flow, there is a high variation or low variation. So variability is high, we call it high risk. Variability is low, we call it low risk. But there are certain times when there will be no variation at all. Means whatever earlier was there, earlier your net cash flow was 100, this year so 100, next year so 100. So your net cash flow is not varying at all. So it is going in a straight line. It is neither this. So either it is going up or going down. It is not like that. Simply it is going in a simple line. So it is not changing. So hence the net cash flow does not change. So when there is no variation in the net cash flow, we can call that as a risk-free or zero risk type of business in banking. That means, for a simple example I'll give, suppose somebody invests 1 lakh rupees in a bank FD. A customer comes and deposits 1 lakh rupees in the bank FD or invest that in a government bond for 5 years. Where the agreed rate of interest payable by the bank or government is 6.5% per annum, which is to be paid half yearly. That means what? That means 1 lakh rupees per year you will get 6,500. So half yearly you will get 3,250. 2 half years you will get. So that means what? He or she would be receiving interest of 3,250 every half year for a 5-year period, and finally they will be getting back the principal amount on maturity. So here the cash flow is constant. It is not varying. Every half year he is getting or she is getting 3,250. So you can say that cash flow does not vary. So there is no uncertainty at all. So whenever such cash flow does not vary, they remain constant for a period of your investment time, then this type of investment can be called as risk-free or zero risk investment. The thing is that a return on such zero risk investment or risk-free investment would be always low as compared to other opportunities available in the market. So other opportunity might be available, like say shares, debentures, etc. are there, other than bank FD and government bond. So here in share, somebody can invest. So share is a certain thing where you might also encounter high profit or high losses. So that's why it is told that the return on other type of investments available in the market will be always better than this return on this risk-free or zero risk. Because here, since the bank or government is providing a risk-free thing to you, so definitely as the maxim goes, high risk, high return, low risk, low return. So low risk-free means it is a low risk, so return will be always lower than other such investments which are available in the market. That much you have to understand. Is it clear about this thing? The probability of risk in high risk and low risk. So both can be possible.
Clear, sir.
Clear? Okay, fine. Now, in that example, I'll say, so we have encountered in high risk business and low risk business. So there is a possibility, two possibility I'm talking. I'm not talking about zero risk here. So high profit or high loss. So here low profit or low loss. So all these things are possible. Okay. Now, when profit is happening, as I told you, as long as profit is happening, we don't have to worry at all. We are not going to think about risk management, or the risk management thing doesn't come into us, because as long as profit is happening means we are ascertained, or we take it granted that we have taken care of the risk. But whenever the loss happens, then only we think that yes, risk has not been properly managed. That means what? High risk will be pointing towards high loss. So high loss means what? High loss means you have to be ready to absorb the loss. So as I told you earlier, our aim of risk management is to build capital, make the capital stronger to prevent bankruptcy. So in case of high risk business, since there is a possibility of high loss, we have to always maintain higher capital. So when you enter into high risk, you do not know whether there will be high profit or high loss, but you know that there is a chance of high loss. So I have to be ready before I enter this. So I have to carry high capital. If I am having high profit, then no problem at all, because my capital I have maintained just to avoid this high loss or compensate the high loss, so that I will not face bankruptcy. Similarly, in case of low risk, you do not know what will be profit or what is the loss. But you know that loss might be less. So you should be ready with low capital or less capital. So high risk business will always carry high capital. Low risk business will always carry low capital, because this is associated with high loss and this is associated with low loss. Because this is the only truth applicable. This is here, the result is only one. High risk, high capital, that is the only one truth. Low risk, low capital, only one truth. But here, profit and loss is concerned, there are two things. These are the possibility. Profit might be there, loss might be there. Here also profit might be there, loss. But only one truth is here as regards the capital, that for high risk business, you have to carry higher capital, and low risk business, you have to carry low capital. Because sometimes this question comes, most of the people get confused. So always remember, the only one truth is that high risk business, always you see the option where that option is true. That is, high capital is always, it will be true. Low risk business, low capital will be always true. This high profit, low risk, low profit, high loss might be, they are both might happen also in high risk business. Okay, So this is what the basic thing about. If you understood this, then no problem. Suppose I'll give an example to understand more other things about this thing. Suppose you have some money to invest and you have gone to a bank or any investment banker or any company or any way. They showed you two type of investment, investment 1 and investment 2. They have told you that this, if you invest this, say how much you are investing. So every year, the return will be say 10,000, 10,000, 10,000 for 5 years. Yearly return will be there. And total return is 50. Total return will be 50,000 after 5 years plus your principal will be given to you. Okay. Now they have also shown the investment 2 where the returns are variable. So first year 9 rupees, second year 10, third year 13, fourth year there is a negative return, fifth year 21. But the total return after 5 years is 50 only. Somebody's mic is on. Can you please mute the mic because some background sound is coming. Please, I request you to please mute your mic. Unless there is a question, you should not. Okay, here two options are given to you. The returns are same after 5 years. But the yearly returns are different in investment 2. So if I ask you, where you want to invest, what will be your answer? Out of these two, where you want to invest?
Investment 1.
Definitely, 99% people will choose investment 1 because they want that return. These are the constant return, every frequency of 1 year, they are getting this return. Why somebody will get a return, no return in 4th year? That might be a much more return in the 5th year. But ultimately 50 is the, so you will say that, why should I go for investment 2? I will always try to invest in investment 1. It is very simple. Though from the return point of view, both are yielding the same return after 5 years. However, one is more likely to prefer investment 1 over investment 2. This is because of the fact that there is a steady stream of cash inflow associated with the investment. Now, suppose along with these two, third investment is also shown to you. Third investment says that this 14, there is again variation in the net cash flow, but the ultimate return is after 5 years, it becomes 54. Now you tell me out of these three, where you want to invest. If 3 options are given, where you want to invest?
Third one.
Third.
Investment
So
3.
most people say 80% of the people, if 3 options are given, 80% of the people, they will choose the investment 3. Why you have chosen? Simply for the fact that you have not seen this -4 or -3, whatever I'm getting. I know that after 5 years, I have a +4 here. 4,000 rupees extra I'm getting. So why should not I choose investment 3? Some of the traditional people, they will not bother about this. They'll say, no, I don't want 4,000. I want steady income for 10, 10, 10. So that 20% people might not choose. But 80% people will shift from investment 1 to investment 3. Only for the fact that there is an additional return. This additional return might, how much it will be? So if you compare this additional return, it might be 0.8% extra return you are getting. So this return, because of this extra 0.8% or 4,000 rupees you are getting, you are shifting to this. So this is called the risk premium. That because this is a risky one, and this is totally risk-free, 10, 10, 10, 10, risk-free. Whenever there is a variability in net cash flow, that is risk. So this is called the risk premium. Or we can call that this is the cost of risk. So unless you pay some risk premium or unless you pay the compensate the cost of risk, nobody is going to invest in such a risky type of investment. So we can say that higher the risk, higher will be the premium. The more risky investment, premium should be always more. If premium is not more, people will not be interested in investing in you. So similarly, you see the insurance you take care of. So amount of insurance you cover you take for life or vehicle, whatever you take. When the vehicle, new vehicle amount is more, you have to pay more premium. When you take a life cover for 5 lakh and you take a life cover of 1 crore, the premium on 1 crore will be always more because their risk is more. So that is the cost of risk. So when risk premium is not given, people are not going to be interested in your investment. Or alternatively, when the risk premium is not there, that is higher profit is not there, then why should as a banker I will enter into high risk business? Because of that cost of risk is there, I can manage the risk to get that cost as a high profit. Is it clear to you? I hope this is clear
Yes,
to
sir.
you.
Yes, sir.
Yes, sir.
Okay.
Yes, sir.
So now we should understand this, then we'll just see how to. So till now I have told you, first thing I told what is risk, then I told you about how the relation of risk to the capital, because entire risk management we will be talking about capital, how to calculate capital, how to manage capital, how to bring the capital more, only for the fact that we want to save the bank from bankruptcy. And we are doing the risk management to strengthen the capital. And the capital comes from the return only. Return is the profit we earn. If profit you cannot earn, how to maintain the capital, how to increase the capital, how to strengthen the capital. So there has to be a profit. So you manage risk efficiently, earn profit, build capital. This is the three things are inseparable, or that is the linkage between this risk, capital and return. Always all the things are there. Okay, now we'll see that's why the RBI under Basel norm, which we'll be discussing in later classes, always speaks about the minimum capital required. So every business we do, every type of bank which does the business, they should have this minimum capital requirement. So what is that minimum capital requirement? Minimum capital requirement for a business should be such that that capital is able to meet the maximum loss that may happen or rise from the business, which should avoid bankruptcy. So that means what? This minimum capital requirement, or MCR, will vary from bank to the bank as per the business. So small bank might be there, a big bank might be there. So big bank like SBI, a small bank like say I can say Federal Bank or Karnataka Bank, whatever. Small banks are there. So for them it will be different. SBI has a very big turnover. Their business are very huge. So for them, the amount of minimum capital requirement will be definitely amount wise. Amount wise, it will be more than the capital required for Karnataka Bank or Federal Bank. So I can say that for them, it might be 20,000 crore rupees of capital. For this bank, it might be possible that 4,000 crore will be enough. So what is this minimum capital requirement? That is, this amount of capital is required to compensate the maximum loss that may happen in SBI, and that will prevent SBI from bankruptcy. Same happens to this also. 4,000 capital is the minimum requirement for Federal Bank or Karnataka Bank, which will be meeting the maximum loss that may happen in that year, so that losses can be compensated to the capital and bank will not face bankruptcy. So this minimum capital requirement is prescribed by Basel. But that means, I told you, capital requirement for high risk business, SBI I have given you. They are entering into high risk business. They are doing a very big, tremendous amount of business. Their turnover higher. So capital requirement for high risk business will be always higher, and low risk business would be always lower. This is the basic linkage between risk and capital. High risk, high capital. Low risk, low capital. That is the basic link between risk and capital. And the capital comes from the return. So you should, high risk business, you should manage to get higher return so that you can allot more capital. So we can say that as regards of profit loss, we can say that high risk business either higher profit or higher losses, already explained to you, and low risk business either lower profit or lower losses. But only truth here that higher capital here, lower capital here. That is the only truth which is prevailing. This is the linkage between risk, capital and return. And finally, we can say that when the risk in business, Sanjeev, please mute your mic. When the risk in business or investment is netted against the return from it, you try to understand this. When the risk in somebody's mic is still on. Can you please mute, please? Senthil Kumar, please, can you mute your mic? When the risk in a business or investment is netted against the return from it, then it is called risk adjusted return on the investment or risk adjusted return on the capital. So sometimes question comes, all these red things I have in the slides are there, so you should be carefully remember those things. So what is this risk adjusted return on the investment or risk adjusted return on the capital? So RA, ROC, or will be called RA, ROI, risk adjusted return on the capital or investment. So we are basically making both the thing. Our fund is the capital or our fund is the investment we make in the bank to get a return. So what is it called? A risk adjusted return on our investment or capital. That means, suppose we are giving a loan. Simple thing, a loan is given. Suppose a loan is given, say 100 rupees loan has been given. Say 10% is our rate of interest we charge on this loan. That means in a year we get 10 rupees. Out of this 100 rupees we have invested or given as a loan, 10% annum we will earn. So 10 rupees is the amount of return we'll get. But since it is a loan, we know that there is a risk. So there is a probability that this loan may go bad also anytime. When it goes bad, this rate of interest 10 rupees will not get. So to cover that loss when it happens, we have also taken care of risk management. Say we have taken a collateral against it. We have taken so many things. So for that also, some cost is incurred by the bank. So that cost, we can say that cost is say 0.1%. This cost is towards the risk management cost of this loan, say 0.1%. That means what? This 0.1% bank is spending on this loan always. Return is 10%, 0.1% is spent by the bank to manage the risk. So basically our return is how much? 9.9% only. So our return is 9 rupees 90 paisa, not 10 paisa. So when this risk factor for which bank is spending some money is netted against the return. Whatever is the ultimate result comes, 9 rupees 90 paisa, 9.9%. This is the risk adjusted return on the capital or risk adjusted return on the investment. The risk amount is adjusted from the return. So you should understand that RAROC, ROE. What is this? Because sometimes question comes. Is it clear? RAROC is clear to you?
So once again, please, sir.
Once again, sir.
Please repeat, sir.
This is not a song here. If I sing a song, it is good, then you can say that, yes, please repeat the song, repeat the song. Simple thing. I told you that 100 rupees loan is given. 10 rupees is return. You are charging interest 10 rupees. So return is 10 rupees. So 100 rupees every year you are earning 10 rupees. But since it is a loan, there is a risk in it. And for that, bank is doing risk management. And doing risk management means in banking, when you do, there is a cost of also borne by the bank for to manage this loan. I am talking about just one loan. I am talking about the whole entire process of the bank. Whole housing loan, whole vehicle loan, all other loans. So for that risk management, a team is there. Entire bank is buying softwares. Bank is doing a lot of things to prevent the losses. For that thing, you spend money. So for this loan, I am telling that the money spent to prevent the loss is say 0.1%. That means this is outgo. This is the outflow. Outflow is 1%, 0.1%. This is the inflow. So net cash flow is how much? Net cash flow will be 9.9% only. Because 10 rupees, here 10 paisa has to be deducted. So your resultant profit becomes 990. Actual profit is 990, not 10 rupees. Although you are earning 10 rupees, but you have spent this much amount on this risk management. So risk factor has been adjusted to the return. So ultimately your actual profit earned from this loan is 990, not 10. So this 990 is called RAROC or RAROI. Is it clear?
Yes, sir.
Yes, sir.
Yes, sir.
So this is the adjusted. So every transaction, every business we do to earn something, we undergo risk management process. So that amount which we are spending in the risk management process, that has to be netted against the each return we receive. So if you say that our earning is 10% on this loan, that is not correct, because we are not netting the risk factor into this time. So when you do that, then only you can say that that is the actual return. So actual return is the risk adjusted return on the investment or risk adjusted return on the capital. Okay. Now we'll see the last slide we'll do there before we end today's class. So risk adjusted return, RAROC or ROI, is the key factor. Always remember, question comes. Key factor in the investment decision of any investor. So whenever an investment is made, suppose I am making an investment or bank is making an investment in doing giving a loan. So everything is an investment only. So in those investment decision, what is the key factor? Key factor is what is its RAROC. It is not about the what is return was 10%, but RAROC was 9.9%. So this is the key factor. We should always see, before making investment decision, we will have to look into the fact what is the RAROC, what is not the return. Direct return is not concerned. We should always see what is the risk adjusted return on that investment. So RAROC is always the key factor in the investment decision of any kind of investor. So higher the RAROC, higher would be the reward. Simple thing. Suppose somewhere the cost is more, so it is 9.75 or it might be 9.60. That means this is the highest of ROC. So I can always choose that this is the return I want. So higher would be the reward when higher is the ROC. So, or we can say that lower would be the reward, lower is the ROC. So we can say that another important thing which comes in the question, you can remember that the key driver in managing any business is to increase the ROC, is seeking enhancement in ROC. That means our total business of the bank, we should always aim that our ROC should increase year by year. Entire thing we are doing, we are adjusting the risk part from the return. And every year, this ROC, whatever the total ROC we are having, our aim is to increase this ROC. So key driver in the managing any business. So bank's management or bank CEO always look for increasing or enhancement of this ROC of your bank. Otherwise, your profit is not going to.
Sir, whether ROC and provision is having any connection?
Provision. Why provision is coming here? We are talking about capital. There is no provision thing coming here.
Okay.
Provision. See. Okay. I got your question. Yeah, definitely. Yes. I got your question. So provision means yes, that is a factor for encountering the risk, because see, provision comes when provision comes. When provision comes.
If it go bad asset.
Okay. So when it goes bad, we are making provision, but there is also, so those are called NPA provision. We will talk about this NPA provision in the balance sheet management. And there are also provision for a standard asset.
Yes, sir.
Do you know about it or not?
Yes, sir.
Standard
Yes, sir.
asset provision.
Okay.
NPA, so when NPA happens, this means already loss has happened. Definitely, when loss happens, the provision amount is much more than the standard provision. When the loans are standard, they are performing. Even though they are performing, we have to make provision. So that provision is gradual, very small. Say general provision for standard asset is 0.4%. When NPA happens, when it is substandard, so provision becomes 15 to 25. When it becomes doubtful, it becomes 25, then 40, then 100 also. When lost, 100. So gradually it is increasing. So why this is done? This is, as somebody has asked the question very correctly, these are the provision we are making to avoid the loss which has happened due to NPA. So that at one point of time, we might write it off. The entire loan might be written off. So entire loss will not happen suddenly. So gradually we are making provision from taking the amount of the profit. So this is also a part of risk management, as somebody has pointed out. Yes, this is one of the cost of risk management. Correctly point out. So this is one part. So entire thing we have to take care. What are the costs we have incurred to secure the loans, to secure our losses, to prevent the losses? So provision is definitely a part of the cost of risk management. Yes, correctly said. Okay. Then up to this we'll discuss. Anything else is there you can ask, so that we can end today's session and we'll meet tomorrow again. Up to this, the fundamental part of risk management is done. Now we'll, after next tomorrow onwards, we will be discussing about different things where some interesting factors will come, some questions will come. So I will suggest that you will be always careful and focus on this, so that when the numerical things will come, if your concept will be clear in those numerical things, you may score higher marks in risk management and balance sheet management, and together it is BFM. BFM, you can score more than 70 marks. It is possible if numericals are done correctly by you. Okay?
Sir,
Sir, can you
Yeah.
just explain upside potential and downside
See,
potential?
simple thing. Upside potential. Upside means what? Upside means what? Normally, when you say upside means what? Upside, downside, up and down. Which is good? Upside, up is always good.
Yes.
Down is bad. So up means it is a positive, and down means it is negative. Potential means what?
Ability or like.
Whatever your capability, or there is a possibility is there where positive outcome will be there. And downside potential means there is a possibility that there might be a loss. So upside potential means always there is a profit. And downside potential means always it is about the loss.
Loss.
Simple thing. This is the meaning. And how this downside potential is used in risk management, we will discuss in further class. Just to simple to understanding upside potential, when you come with this term, upside potential, downside potential means we are talking about profit and loss. Whenever it is downside, always remember we are talking about loss. Upside means it is over the profit.
Okay, sir. Thank you, sir.
Somebody is told to provide PPT. No, I cannot provide PPT unless module B is completed. I am not going to provide PPT. So please excuse me for only 9 PPTs I have said, 10 PPTs or 11 PPTs I have said today. So it is not possible. For the last 7 years, I am doing the same thing. After the module is completed, I will share it. Do not worry. Okay. So please, it is not my fault that you have joined lately because class starts at 5:30. So you have taken the risk. So as I was given in the example, there was an interview at 10 o'clock, but he could not reach. So you will also, if you continue with this risk of attending the class late, it might be also possible that you might not reach your examination center in time also. So please manage the risk. If you do not reach the examination center in time, you will fail. But at examination day, you will not forget. You will take proper risk management. But while getting up early to attend a class, you will not take care of risk management. That is not good. Every possibility thing in happening in the life, we should always take care of risk. Otherwise, and so see now you have missed some of the part, and you are asking for the PPT. I am not giving you, so that is a loss to you. You will be getting after the module is over only. So always try to manage the risk. It is beneficial for you only. Okay, so see you tomorrow.